Hello and welcome to the Scan the Markets webinar with myself, David Madden. I do want to apologise for the late start. Once again, a bit of technical issues, but I do apologise for the late start once again. For those of you that have not been to one of my webinars before, my name is David Madden. I work as a market analyst for Equity Capital in London, and that is one of the many companies within the overall equity group. There's Equity Nigeria, and there's also FX Pesa in Kenya. For those of you who've not joined one of these webinars before, what I'll essentially do is I'll run through about 5 of the major markets, talking about the interesting price points on the chart. I'll talk about the fundamental news that's driving the markets. If anyone has any questions for me throughout the live stream about if you have any questions about saying I don't understand that, would you mind please going over this again? I'm happy to answer your questions. If you have any markets that you want me to take a look at, or I've talked about the markets in general, feel free to just put that in the chat box at the bottom. More than happy to talk about that. Particularly markets, I don't really look at a whole lot. It's always fun and interesting to take a look at those. So first things first, I'll talk about euro dollar. Euro dollar has a very interesting move this week. It's dropped to a 20-year low yesterday. Actually, it's actually rolled over yet again. So it's dropped to a new 20-year low in the last few hours. Why is this? Well, there's a couple of things going on. First and foremost, a strong US dollar. The US dollar has been very strong across the board against a whole host of currencies, but particularly against the euro. What we saw was, we saw the US dollar index itself hit a 20-year high. That's largely down to the fact that there's weakness in the euro, because a large component of the US dollar index is in fact the euro itself. But we've also seen the dollar make strong gains against the British pound, the Australian dollar, the Canadian dollar, and also the Japanese yen. So the dollar is strong across the board. What's also going on with the euro? Well, they're concerned the eurozone could be edging closer and closer to a recession, either the region as a whole, or Germany, the largest economy in the eurozone. If you take a look at what's going on with the eurozone, the most recent services data came out of the eurozone showed growth at its slowest pace in 5 months. We've had pretty sluggish growth in terms of manufacturing. Inflation in the eurozone is at a record high. We saw inflation at multi-decades high in Germany as well. There are concerns that demand is tapering in Germany and also the eurozone as a whole. So a mixture of a strong dollar and also fears, a mixture of a strong dollar and a weak euro, because of recession fears in the eurozone has been clobbering the euro-dollar currency pair. Taking a look here at the price action, we can see it's been in a strong downward trend. Just to let you know, all the charts I've been looking at are typically on a 4-hour time period. So I'm looking at a 4-hour chart here. I have 3 moving averages on the chart. This moving average here is a 20-period moving average. I have the 50-period moving average, and I also have the 100-period moving average. Looking at the price action here, we can see it's the currency pair is well below all 3 of these simple moving averages. While it continues to hold below these 3 simple moving averages, it's likely the more medium-term bearish trend will continue. A move lower from here could see a target parity, 1 spot 0000, and a break below that could see us down to 0 spot 9900. Break below that could see us down towards 0 spot 9800. Taking a look at the relative trend index, the RSI, it's essentially kind of a measure of if a market is kind of overbought or oversold. It essentially kind of measures how quickly a market turns in a certain direction. And we can see here that the RSI is below the 30 gauge here, the 30 mark. So it's in oversold territory, indicating, this could be an early indication that the recent downward move in price has become overstretched to the downside. If that is the case, this could be an early warning that the market is overdone. The downward move has been overcooked, as it were. If you do see a snapback in euro dollar, where could we target? Well, I'd be looking back up towards this moving average here, the 20-period moving average. He followed it around. You can see it acted nicely as resistance here, 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 and here as well. In fact, it actually also acted as a support in this zone as well. So what I often say, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, but obviously there are no guarantees. If you do see a rally from here, I'll be looking out for this moving average. That comes into play at 1.0258, and a break above that could see a target this zone here at 1.0324. Looking now here at the US 500, the S&P 500, we heard from the last night, almost 24 hours ago. We saw the minutes from the June Federal Reserve meeting. Now, even though the Federal Reserve said if inflation continues to be high, we might look to use even more restrictive monetary policy as a way of tackling the high levels of inflation. But that being said, they also said they expect economic growth to rebound in the second quarter of this year. So it was a hawkish update, make no mistake about it. But to be fair, given the Federal Reserve hiked interest rates by 75 basis points in June, traders were kind of half expecting another 75 basis point hike in July. Now that meeting, the July meeting, is yet to happen, but judging by the notes, or the minutes from the meeting, there is a belief that although the meeting was hawkish, it could have been more hawkish, or to put it another way, it wasn't as hawkish as some people might have feared. So with that, you saw a tick higher in US stocks. We could see a sharp move to the upside in the US 500. In fact, the US 500 is now back up to a level last seen on the 28th of June. So we're talking about near enough a one week high, or approaching a 10-day high on the US 500. You know, looking at the MACD indicator, which is a measure of momentum, we can see that momentum is firmly in positive territory, indicating that bulls are in control. Looking at the RSI, it's moving higher. If the RSI is moving higher, that's typically a sign. That typically means the price bias is to the upside. That's moving higher. You know, we're above all three simple moving averages. While we continue to hold below all three, while we continue to hold above all three simple moving averages, it's likely the short-term upward trend will continue. A rally from here could see a target at 39.46, and a break above that could see a target at 40.24. Now, even though the short-term trend is clearly to the upside, it's worth noting the much longer-term trend is clearly to the downside. So, kind of a big picture view here. This is far from a perfect trend line, but just to give you an indication, the really big picture view for this market is to the downside. Now, I'm looking at a 4-hour time frame here, but whatever time frame you're kind of comfortable looking at, always make sure to zoom out to a larger time frame, and the next largest time frame, and the next largest time frame, because for all you know, there's actually a major trend in effect that you can see. And if you're not looking at the bigger picture, you can easily get caught out, because some people might be in their own bubble looking at a certain time frame and thinking to themselves, oh, this market's clearly breaking higher. That's it. The only way I should be thinking about is buying, and because the market's going to go higher. You do have to be always mindful. There are trends within trends. So sometimes you'll see a scenario like this whereby the market's moving aggressively higher. But if you look at the bigger picture, you can see the recent highs have yet to retest the highs of late June, and the highs of late June are nowhere near the peaks that were set in early June. So they've got a much longer term trend issue the downside. So, and what I'm getting at is, if for example, we're right up against this trend line here, it may or may not act as resistance. If it does act as resistance and the market starts to move lower from here, which it could do, we're going to potentially find support. But I'll be looking back down towards this moving average here, the 100 period moving average, that comes into play at 37.89, and a break below that could see us back down towards 37.40. This is what I mean about the various different trend lines. So the 4-hour chart makes it quite clear there's a long-term downtrend in play. If you're to look at a half-an-hour chart and ignore the rest of it, you might look at this and go, wow, that's a very aggressive move higher. You know, we jolt higher here, we traded within in a certain range. We had another jolt higher here, creating a new high. The market has a pullback. this low here is clearly above this low, and the market keeps on going and going. So you might look at this time frame and think, wow, it's clearly in a strong upward trend. By the way, I'm looking at a half-hour time frame here, but if you switch it over to a jump 2 time frames out larger, out to a 4-hour window, you can see that this short-term upward trend is only one piece of the puzzle, when in fact the much longer-term trend is to the downside. So most of the time, the charts I've been looking at are 4-hour charts. What I just showed you there a minute ago was a half-an-hour chart, and it goes to show you a different time frame between a half an hour and a 4-hour time frame can tell you something very, very different about what's going on in the markets. Coming on now to the UK 100, the FTSE 100, it's had a bullish run because the rally we saw in the US last night, the rally we saw in Asia overnight, led to a rally in Europe here today. Also overnight, an announcement from Beijing that the Chinese government said they're looking at doing a stimulus package of $220 billion in infrastructure, looking at kind of regenerating the economy. That's had a strong impact on energy stocks and metal stock and mining stocks. So there's a fairly large portion of the FTSE 100 is made up of commodity stocks. They outperformed today. Overall, there's been a risk-on attitude. By risk-on attitude, I mean people are willing to take on more risk. If you're willing to take on more risk, you clearly are upbeat about the kind of state of the economy and state of play. So the broad rally we saw in stock markets across the board pushed up the UK 100 today. You can see it's above all 3 simple moving averages. It's been rallying in the last 24 to 48 hours. The RSI is moving higher. The MACD indicator shows us it's in positive territory, indicating the bulls are in control. If you continue this kind of short-term upward move, where can we target? Well, I've been looking towards this peak here at 72.83, and a break above that, I've been looking toward these peaks here around 73.45. Once again, the very short-term trend here says the market's moving higher, but let's not forget the much longer-term trend looks a lot less rosy. In fact, I'll actually draw in that trend line here. It looks a lot less rosy. So we're quite close to retesting that trend line. And a trend line, for those of you who read about technical analysis, will know if a trend line has 2 points, it's a tentative trend line. If a trend line has 3 points or more, it's a confirmed trend line. And if you take this to be point number 1, point number 2, point number 3, point number 4, we're not too, so we have 4 points on that trend line. It's a confirmed trend line. Not to say trend lines always work, but for the time being, it's a possibility. This market might encounter trend line resistance. It might edge a bit higher and then move lower. And perhaps it could even actually break above it. Use that the old trend line resistance might become trend line support, and the market could use that as a foundation to edge higher and higher and higher. Who knows? But as far as I'm concerned, the longer term trend is to the downside. As far as I'm concerned, when we continue to hold below this trend line, I suspect that much longer term trend could remain in effect. If we do decline from here, where can we target? Well, I'll be looking down towards 70.68, and then below that, I'm looking down towards the July lows of 7,009. If you break below that, I'll then be looking down to the lows that were set in mid-June. Coming on now to gold. Well, what's been going on with gold? So gold's had a major move to the downside. We can see here that gold recently fell. Yesterday, it fell to its level last seen in September last year. So we basically had a 9-month low, or kind of 9.5-month low in gold yesterday. That really tells you everything you need to know about how bearish sentiment is if the market has dropped to a 9.5-month low. We're below all 3 of these simple moving averages. While we continue to hold below these moving averages, it's like it's a more medium-term downward trend will continue. Moving lower from here, we could look to head that back down towards 1721, and a break below that could see it down towards 1700, and a break below that could see it down to the July low. Excuse me. Excuse me. A break below 1700 could take us back down towards the lows of late July last year, and that's in around the region of 1678. So if we go below 1700, keep an eye out for 1678. But if you take a look at the price action in gold in the past, 12 to 16 hours, the market has rebounded somewhat. Not very much a rebound, but a rebound nonetheless. Looking at the MACD indicator, we can see that momentum is in negative territory, but there's a steady decline in negative momentum. So the bears are no longer as influential as they once were. Looking at the RSI, it's still in oversold territory, which acts to me as a bit of a kind of flash warning to say that, the recent sell-off could be a bit overdone, it could be a bit overcooked. But notice how the RSI is still moving higher itself. So although it's oversold, it's not as oversold as it was a few hours ago. So if you do see a continuation in this short-term upward move, where can we target? Well, I'll be looking toward these peaks that were set here in around 1772, and a break beyond that, you can see it targeting up toward this area here around 1786. If you look at the low here, and the high here, it all kind of hangs around the kind of 1786 level. Strong kind of line in here. It seems to be, a classic example of this area acted as support here and the market was falling. As a bit of a rebound, the market rolls over on itself. It kind of has a bit of a pause here briefly before it moves lower again. So keep an eye out for 1786 to the upside on gold. And then of course, if you break above that, excuse me, if you break above 1786, the next big level to watch out for will be 1900. Coming on now to oil. So I should have actually covered this in gold. My apologies. Not only is a strong US dollar impacting gold, because gold is traded in US dollars. When the dollar is strong, that typically weighs on gold. When the dollar is weak, it's typically pushes the price of gold higher, because if you're in the UK, if you're in the Eurozone, if you're in Canada, for example, your domestic currency will buy you more American dollars because the US dollar is weak. And therefore, for the same monetary amount of your domestic currency, you get more US dollars. When you get more US dollars, you can buy more gold with the same monetary amount in your domestic currency. So if you trade gold at all, it doesn't matter if you trade currency pairs or not. If you trade gold, always be keeping an eye on what's going on with the US dollar. I mentioned a few minutes ago, euro dollar dropped to a 20-year low, and then conversely, the US dollar posted a 20-year high versus the euro. We've recently seen the US dollar at a multi-decade high against the Japanese yen, and multi-year highs against other currencies. When the dollar is strong, that typically bodes badly for gold. When it's weak, it typically helps gold. What's also playing into the mix for gold to a certain extent is bond yields. The yield on the US 10-year government bond is now about 3%, which isn't a huge amount, admittedly, but considering, if we were to go back, say, 1 year or 2 years, yields back then were far, far lower. And part of the reason why we had such a booming stock market a year ago or 18 months ago was because interest rates by central banks were basically zero. Therefore, in most cases, the money you earned on deposit at your local high street bank was basically zero. Because interest rates were zero set by central banks, bond yields were very depressed. They were very, very low in some cases, and in some cases they were actually negative. So that's why stock markets and the likes boomed a year ago or 18 months ago, because it's almost like the cash and bonds section of the overall investments community wasn't worth investing in, to be honest. Between cash and government bonds, people just put a huge amount of cash into stocks and metals and the likes. Now I think we're seeing a bit of a reversal. We're in an environment where gold is falling and yet bond yields are relatively high. The US 10-year yield is now around 3%. It recently got up to, I think it was about 3.4 or close to 3.5. Anyways, the US 10-year yield recently hit an 11-year high. So people say to themselves, I can invest my money in the stock market, I can invest my money in gold, which is falling, or else I can invest my money in US government bonds, which are basically risk-free, and they give me a return of around 3%. So when yields start to move aggressively higher, people then kind of go, well, actually, maybe if I'm going to invest in a safe haven, perhaps it should be something like government bond as opposed to gold, because gold doesn't pay any interest or what's called coupon, the payment for connected to a bond. Coming on now to UK oil. So UK oil has come under, has seen a fair bit of volatility. What's been driving this move? Yesterday we saw UK oil, Brent crude oil, fall to its lowest level since mid-April. So we talked about a kind of 6-7 week low. What's going on with UK oil? Well, essentially there are creeping fears about a cooling in the global economy, or else even concerns that some of the major economies of the world, the US, the United Kingdom, Germany, they could be heading towards a recession, or maybe at the very least their economies will cool down. Who knows? There might even be a recession. So there are a lot of concerns about demand level going to dwindle. That's hanging over oil. That's why we saw a sharp move to the downside. That being said, oil is still holding up fairly well. UK oil, Brent crude is trading around $104 a barrel. Why is this? If there's all these kind of recession concerns for the UK and the US and the global economy will slow down, squeeze supply levels. OPEC are in no major rush to get back to their pre-pandemic level of production, which has been fairly, and in the last several months, OPEC have been increasing their production, but at a fairly slow pace. That's a factor. Also, Russia has been essentially there's embargoes against Russia when it comes to energy. So they're essentially kind of frozen out of many purchasers of oil have essentially frozen Russia out. So it's keeping supply relatively squeezed, and that's why oil is holding up. But oil like other commodities such as silver or platinum or palladium or copper, these are sort of industrial metals which are used to kind of essentially fuel the economy, fuel economic growth. Copper recently fell to a 17-month low. Silver recently fell to a 2-year low. So industrial metals are falling through the floor because people are afraid the global economy will slow down. Whereas oil is only falling to a 6 or 7 week low because of the squeeze supply issues. But there are concerns that if inflation runs high for too long, partially because of high oil and energy prices, the high level of inflation will chip away at demand around the globe. And then that eventually reduce the demand for oil. So we could see further declines in oil in the next few weeks and months. So, we saw oil here, UK oil, fall to a 1 month low in latest June. The market recovered, didn't make a full recovery, a bit of a pullback, tried to make another recovery, and then moved aggressively lower yesterday. So what's going on with UK oil? It's it rebounded from a 6-7 week low. Although it's reclaimed the 20-period moving average, it's still a long way below the 50-period moving average and the 100-period moving average. So the more medium-term trend is to the downside. While we continue to hold below these two simple moving averages, I suspect the medium-term downtrend will continue. A move lower from here could see it retest the recent lows of 97.13 and a break below that. And a break below 97.13 could see us back down towards 95.23. On the flip side, though, take a look at the price action in the past 24 hours. We see a very aggressive move to the upside. We've cleared this peak here. We've already moved back above the 20-period moving average. Looking at the MACD indicator, momentum has swung from negative territory to positive territory, suggesting that the bulls are in control. There's a sharp move higher in the RSI. It used to be an oversold territory. And this is what I mean about, observing price action. When we had aggressive move to the downside in the price, the RSI moved into oversold territory. That sometimes acts as a warning to say, a flash warning to say, perhaps the sell-off could be overdone. We may not see a snapback. It turns out we did see a snapback, so we saw a sharp move out of oversold territory, and a sharp move to the upside in the price of UK oil. If we continue to rally from here, I suspect we could encounter resistance from this moving average here, the 100-period moving average. It acted basically after a resistance zone here and also here. So it's not unusual. It's not uncommon to think it might act at resistance here again. And that comes into play, around 110.32. If you do break above that moving average, that'll be fairly interesting. Consider we haven't had a proper break above that for several weeks. And if you do break beyond this moving average here, I will looking toward this peak here at 115.88. Got some questions here about what indicator are you using? So this here is the MACD indicator. Moving average convergence divergence is essentially a measure of momentum. Essentially, who's kind of pushing the market around? Is the bulls or is the buyers? And momentum is just simply kind of a rate of change. So if you look at the price action here, we can see UK oil, the price was moving higher here. Corresponding, we can see on the MACD indicator, momentum was in positive territory because the market was moving higher. But we can see a steady increase in positive momentum along here. In fact, you can see here momentum gradually increased. Then we had an aggressive move to the downside in price, and then you can see momentum swung from positive territory to negative territory. Then we saw a deepening further and further and further into negative territories, indicating that not only are the bears in control, they're becoming even more influential than they once were. So they're driving the market around. Then as the market starts to turn around, we can see the bears are still in control because momentum is still in negative territory, but their influence is dwindling. And then of course the momentum swings back into positive territory. This here is the RSI Relative Trend Index. In a similar situation, it kind of measures kind of almost like an elastic band. How stretched is the market in either direction, be it to the upside or to the downside? Now, just to clarify, if a market moves into oversold territory, as it did here, there's no guarantee that it'll automatically just completely turn around and therefore the price will move higher or move the opposite direction. A market can remain oversold for a prolonged period of time. A market can remain overbought for a prolonged period of time. But like with anything in trading, what you're often doing is you're observing price action in the past to try and predict price action in the future. So you can see here that the market was moving aggressively lower here. We can see we swung from being, in the kind of middle of the range to being oversold here, which kind of coincided with this price move here. Well, we can see that we're oversold here, and then what happened next in price? The price started to hang around a bit, and then eventually took off. So it could be something similar with this, what's going on right now. We were in oversold territory here. Market moved aggressively lower, and then that can sort of essentially kind of, for some anyways, act as a reason to buy into the market, and then lo and behold, we see a turnaround in the price. But that, like in trading, that doesn't always happen. There are no hard and fast rules to say if the market moves into oversold territory, it'll quickly turn around and it'll quickly rally out of it again. In relation to the time frames, I'm looking at a 4-hour chart here. So this is a 4-hour chart here. I'm looking at on UK oil. So this is what I mean about the different time frames. If you're on a 4-hour chart, you'll still observe this to kind of go, well, if you look at all the peaks, there's a fairly clear string of lower highs. The market's clearly in a downward trend. I know it's in a perfect trend line, but just to give you a broad visualization, all the peaks, all the highs are clearly lower in a line, indicating the market's moving lower. The price action shows us that it recently fell to a 6-7 week low. That also speaks to kind of being in a downtrend. But if you were to take a look at that on a much shorter time frame, perhaps a 15-minute window, we can see the market's moving aggressively higher. Market bottomed out here, moved aggressively higher. These peaks that are set here comfortably broke above these peaks. The market had a pullback. When it pulled back, it didn't even get anywhere near close to retesting the recent lows. It traded a small range for a while. It slowly edged higher, and then it had a very aggressive move to the upside. And notice how when we moved aggressively higher up here, that comfortably took out the peaks that were set in along here as well. So this is what I mean about how one time frame, in this case, a 15-minute time frame, can paint you a picture of, oh, the market's moving higher. But if you were to zoom out to a 4-hour window, you go, well, actually, this move higher is just an upward trend in a much wider downtrend. Yes, I'll take a look at GBP USD. Any other markets anyone else would like me to take a look at, or any questions about what I've been covering? Once again, I do want to apologize for those who are waiting at the very beginning. GBP USD. So pound dollar if you look at the kind of long-term trend, pound dollar fell back to a level. I'm not looking at a weekly chart. It fell back to a level last seen in March 2020. So we're back to a low of 2 years and 3-4 months. So we're talking about a kind of 27-month low, 28-month low being posted in GBP USD only yesterday. So the fact that the market's actually fallen to its lowest level in well over 2 years really speaks to how bearish the market is. It's a combination of concerns about the health of the UK economy. I mentioned the UK is one of the major economies that traders feel could slip in towards recession. Earlier in this update, I was talking about how the US dollar is strong across the board. It's strong versus the Aussie dollar, it's strong versus the Japanese yen, it's strong versus the euro, it's strong across the board. So when you're looking at GBP USD, even though you may not trade euro dollar, or you may not trade Aussie dollar, or you may not trade dollar yen, it's always worth your while looking at the other currency crosses. You're trading pound dollar, keep an eye on what's going on with euro dollar, because what they both have in common is the US dollar. And that'll help you figure out, in a currency pair, as the name suggests, there's two currencies. You need to figure out, is there a weak currency in the pair? Is there a strong currency? The pound's been broadly weak across the board recently, but the dollar's been very, very strong. Hence the very aggressive move to the downside. So GBP USD has been in a very strong downward trend recently. While we continue to hold below these two moving averages, the 50-period moving average and the 100-period moving average, I suspect the longer term bearish trend will continue. Moving lower from here, I look to retest recent lows. First and foremost, in at 1.1875. Below that, I'm looking down towards 118, 116. These are the levels that I'll be looking out for. Let's take a look at the lows that were set during the pandemic. So we could be looking at, if you really move lower, we could look ahead as low as the lows of late March 2020 in around 1.1450, thereabouts. That would take a fair bit of ground to be lost from here. In terms of, say, areas of potential resistance, well, we could look to kind of retest this zone here. We saw a bit of a consolidation zone here. This peak here comes into play. This peak here comes into play in around 1.2120, thereabouts, this peak here. And the level I'm really interested in is the 100-period moving average here. If you follow this market around the 100-period moving average, it acted perfectly as resistance here in latest June. It acted as a bit of a consolidation zone here in early June. It acted quite nicely as support here in early June as well. So there's about 3 or 4 occasions that metric has been of importance. And as I said a while ago, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, but there are no guarantees. So I'll be looking out for that moving average, and that comes into play in around 1.2167. Any other markets you want me to take a look at? Happy to take a look at some other markets. Just be it currency pairs or commodities or stock indices, whatever it is. Or any questions about the material I've covered so far, and you're kind of just wondering, would you mind going over that again or having another explanation, please? For those of you who are on Twitter, feel free to contact me on Twitter. Feel free to follow me on Twitter, give me a shout, and just ask questions. Obviously, I can't give any advice, but I'm happy to just kind of provide commentary on what's going on with the markets in a similar fashion to how I operate it. Similar fashion to how I'm operating right now, whereby I might just show every now and again, every few days, I will tweet out a chart that I find interesting, I will just basically take a screenshot of a chart, put it up on Twitter, talk about the kind of prevailing trend. If the prevailing trend were to continue, we could target levels A and B. If the market was to move in the other direction, it could target levels X and Y. So my Twitter handle is @dmadden_equity, @DMADDEN_EQUITI. So @dmadden_equity. So feel free to ask me any questions or get in touch via Twitter. Got a comment here about GBP USD was my target. Thanks. Yep, no worries. Happy to help. I've now been chatting for about half an hour or so. If I don't have any more questions, I'll look to wrap things up there. So this is kind of a last chance to kind of ask any questions. Yes, tomorrow will be US non-farm payrolls. It's likely to increase a lot of volatility into the markets. Now, keep in mind about what I said about the Federal Reserve. The Federal Reserve hiked interest rates last month by 75 basis points, 0.75%. After they did that hike, traders began to kind of think to themselves, okay, there's probably another large hike coming in July. It could be a 50 basis points hike. It could be 75 basis points hike. We don't know. To a certain extent, a portion of the market are kind of factoring in a 75 basis points hike. The minutes from the June meeting showed us that they think inflation is still an issue, that they said if inflation remains high, they might even look to use even more restrictive policy, i.e. even higher interest rates to tackle high inflation. But they also said that they expect growth to rebound this year as well. So one of the issues that's affecting the US economy is the post-pandemic boom is over, and that's a bit of an issue. So with that in mind, whatever the reading is tomorrow for US non-farm payrolls, you need to be thinking to yourself, judging the update as a whole, look at the headline number, look at the unemployment rate, look at the average wages component, and kind of blend it all together. I think, did the headline number beat expectations? Was there a revision to last month's number? Did the unemployment rate rise or fall? How are wages doing? Put that all together and try and figure out, all amalgamated, is it a good update or a bad update? And then think about this. If it's a red, I'm just using extreme examples here. If it's a brilliant update, and it's very, very strong, that would probably make it more likely that we're in for another 75 basis points hike this month. Who knows? Maybe even a 100 basis points hike. But conversely, if the number is very, very weak, that might make it more likely we'll have a 50 basis points hike. So you're always viewing it through the prism. It looks as if it's almost a certainty. It looks as if it's almost a certainty that they're going to hike this month. It's just a case of by how much. Will it be 50 basis points, 75 basis points, or the outside possibility of 100 basis points? And that's how you should be viewing economic announcements from the US. They always kind of view, we have an idea what they're going to do. It's just which one of those options are they going to choose? Yes, I do think US non-farm payrolls tomorrow. By the way, I am hosting a webinar. That'll be at 1:30 Nigeria time, 3:30 Kenya time. I'll be covering it. It'll be tweeted out on the FX Pays Twitter handle, and also be tweeted up by myself. In relation to I got a question here about is there an FX account that one can deposit funds or earn interest? To be honest, I'm not the best person to answer that question. I cover more on the markets end of things. If you get in contact with one of my colleagues tomorrow on the new business desk on the sales team, they'd be best to answer that query. I'm much more focused on what's going on with the markets rather than actually on the kind of account management itself. Seeing as there are no more questions, and I'll be kind of talking now for about going on 35-40 minutes, I'll look to wrap things up there. So once again, I apologize for the late start. Hopefully that will be the last time I'll have got technical issues, getting things going and getting off the board. I will be back tomorrow with non-farm payrolls live webinar. I'll also be back next Thursday with another Scan the Markets webinar with myself. And lastly, and one we're going to shout out, feel free to give me a contact on Twitter as well. So everyone, I appreciate your time. I appreciate all the questions. It's always fun to have a bit of interaction. So everyone, happy trading and have a good evening. Thank you very much.